Every founder starts in the same place. You start as the operator. You are the head of marketing and delivery and sales at the same time. But once your agency starts approaching about $500,000 in revenue, you start delegating. You have to, right? You bring in contractors, maybe your first full-time employee, and that's when the profitability question mark starts taking shape in your head, because as your agency grows, your cost of doing business also grows. So it's no longer just about growing revenue, which is why I'm recording this video on the top 3 metrics every creative and marketing agency owner has to track if they want to move past the manager stage and into what I like to call the architect stage, okay? The stage where you start steering the business intentionally, like with a control panel with levers to improve and protect your margins. I'm Jose Cardenas, CPA and enrolled agent with Westfront Tax and Accounting. We provide business accounting, bookkeeping, and tax services to service businesses with a specialization in creative and marketing agency owners. So you have probably heard of KPIs before, and it's normal for the whole topic to feel confusing at first if that's the case. But it's this simple when it really comes down to it. There are really 3 types of metrics out there. First, you have your operational metrics. They tell you how efficient the work is delivered. Second, you have your financial metrics. They give you your results. They tell you if you're making money or not. And third and last, you have your performance metrics, which is what most people allude to when they say KPI. Performance metrics, they connect your operations to your financial results. They tell you things like, hey, which services or clients are most profitable, and whether your agency is ready to hire or is just getting busier. So the first category is operational metrics. These measure how efficient the work is getting delivered, fulfilled. And inside of it, you have a vast number of metrics like churn, utilization rate, full-time equivalents, revision ratios, rework ratios, you name it. You can really swim as close to the surface or as deep as you want based on where you are or where you're looking to get. But nothing cannot be accomplished unless you start time tracking. That's where it all starts. So you start by tracking and understanding your billable versus non-billable hours, then get more detailed depending on what you'd like your numbers to tell you financially. So for example, if you want to see profitability by client, then track as part of your billable hours what your clients take up whenever you do any kind of work for them. And at the same time, the same concept applies if you want visibility into your services, projects, or retainers. So we just finished talking about operational metrics, which explain effort. Now the second big category is financial metrics, which tell you financially what happened. Did you make money? Did you not? And no, this is not just about having clean books. That's just for the IRS, for the taxes. Because think about it. If we look at the very first line of your profit and loss, which is your revenue, if $10 come in through the front door, but that really is 50% or a down payment of a project that spans maybe over 3 to 6 months, your numbers for that given month are going to be misleading, because you'll either be missing revenue that you have already fulfilled for and you're just waiting to get paid for that work, or having too much revenue on a given month for work that was delivered prior to the month in question. So financially speaking, you want revenue to match how you deliver when you deliver the work, because you don't necessarily get paid as you earn money from your clients. There's usually a time gap there. So number one, match revenue to when you deliver the work. Number two is making sure you segregate your direct costs from your business expenses. So any employees, independent contractors, any materials and supplies that you specifically buy for delivering your services should be segregated on your income statement so that you can get your gross profit margin, which is revenue minus direct costs to deliver, which is very important to know as it tells you whether your revenue is actually profitable or is just keeping your team busy. There are many other financial metrics, but getting your revenue and your cost to deliver right are foundational to everything else. Performance metrics are more advanced. They bring together, they bridge the gap between your operations and your financials to explain the underlying why of your profit. So it leans on your operational metrics and your financials to explain things like Your gross profit being a representation of your utilization rate, meaning if your gross profit looks healthy but utilization is low, that tells you that your team has more bandwidth and that maybe they can take on more work for you and you don't actually need to hire. Your performance metrics also tell you profitability by service line, by retainer or project. It tells you your hourly cost at these same levels, even by employee, and more. You can get very detailed. But fundamentally, though, performance metrics only exist within your business if you're invoicing or charging your clients with these same custom added attributions and also your time tracking. The data has to be speaking the same language. So performance metrics only exist depending on how diligent you are with time tracking and how you charge your clients. When you get these metrics in place, you start to better understand your team's bandwidth, where they excel, where there's opportunity to improve, and how much more you can squeeze out of them, and how bringing another hire impacts both your operations and your profitability. At the beginning, you have to take a step back and start with learning how profitability and your sales mix interact with each other so that you can see which services, which clients, retainers, or projects make you the most. Most owners start with getting their accounting and bookkeeping right because of taxes, where they focus on taxes, which is smart, by the way. But tax savings, it gives you a discount on money that you have to either spend or invest, cash that you have to let go of. And we would be talking only about what, $15,000 to $30,000 a year in savings. Improving your operations, running a better business is a completely different ballgame. When you improve each employee's productivity by just 1 hour, for example, the impact across the full team can easily, no exaggeration, be of 6 figures back into your pocket. That's how you get the most ROI from investing into proper accounting, which is exactly what we focus on helping creative and marketing agencies with. Because taxes are important, yes, but accounting is much more than that. Get the whole enchilada in one place. So if this is something that you're ready to invest in, you can book a free discovery call with me. The link is in the description below. And that is all I have for you today. Hopefully you liked the video. Make sure you smash the like button for me, subscribe, follow the channel. And with that said, I'll see you on the next one.